Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I got a little video for you giving a stock analysis, my take on Yancoal. I've been watching the coal space with a lot of amusement, some of the commentary on Twitter, and it's very interesting what difference a year can make. We've had some crazy run up in coal prices, petering off a little bit now. And so I start to ask myself, what are the long-term prospects about this particular industry and who's likely to benefit the most? So let's get into it. This will not be in the eToro portfolio because Yancoal doesn't trade on eToro as far as I am aware. So disclaimer, of course, nothing I say is to be considered financial advice or any advice of any kind. I'm just a guy who loves talking about this type of thing. And so it's me sharing my opinion. I make no guarantees as to the validity of the information. It's just my opinion. This is what I'm doing with my funds and the funds that I take care of. That's it. You need to do your own due diligence. So that being said, if you're interested in learning more of my thoughts and high-level trading opportunities, I actually share them with a premium group inside Substack. It's called the Options Maverick. It's how I generate income by selling insurance options over publicly traded stocks. Not as complicated as you might think. The track record last year was annualized at 25.85%. And this year so far, we're doing about 6.5 per month. It's ongoing. So we'll see how we go with that, but so far so good. Obviously no guarantee of results, but if you're interested, I share exactly what I do and how I'm doing it week by week. It's not dry theory. It's not, paying for information tutorials. It's just me going through literally what I'm doing and giving my opinion and take. If you want to start a free trial, obviously the deal with Substack. Link will be in the description. So Yancoal, it's a coal producer. It's got a mix. It's an interesting mix. It's a thermal coking coal and PCI, which is this kind of hybridish coal that can be sold into various different markets. They've got 7 mines and I believe 2 new contracts starting. Majority Chinese owned, which makes them less appealing, which makes it more appealing for me because the price is usually cheaper. But having said that, there's always a few annoying little like take under bids where the majority shareholder tries to buy out a large amount of more shares for a ridiculously low price. But anyway, that usually gets, well, it always gets rejected for national security purposes here in Australia. We're going to look at the Newcastle coal futures as their I guess, best gauge of price of goods. It's not easy to get the exact price. You have to go through the quarterly report because they do sell different types of coal into different markets. I'm buying this particular company for the cash balance that it has. It's incredible. And the dividends that it's looking to pay out. Macro and meso thesis is very basic. I'm not going to beat the dead horse. You guys can go through all my channel, talk to me, interviewing people, experts in the field, Shabam Garg, Josh Young, so on and so forth, about different energy theses. Justin Huhn on uranium, Manuel Dat talking about coal. So in a nutshell, I'm bullish energy still. Demand continues to increase. The picture gets better and better, and the narrative at the moment is getting worse and worse. And that's exactly where I look to zig and not zag, because it's where the opportunities are. Coal is probably the most hated, and this is a good thing because it means you can get in to these investments at a lower price. Chart on the right is from Javier Blas's Twitter, and it's just showing the demand increase for coal. Everyone just forgets about coal, thinks it's going to become extinct. One day it eventually will, but not within 3 years, in my opinion, which means that any company trading for less than 3 times its cash flow is worth a look. That's just my opinion. So Yancoal here, let's take a look at a basic balance sheet on a one-pager. Market cap in Aussie dollars, 6.8 billion, 1.3 billion shares outstanding, negative net debt. They've got so much cash, it's not funny, and they're trading at less than the tangible book value. Okay, if we look at more of an income and cash flow perspective, next 12 months, you're looking at buying this company at 1 times its expected EBITDA. At 1 times, crazy. Free cash flow of the last 12 months, 6 billion. I don't think they'll be quite that good. Coal prices have dropped off, but they'll still be quite reasonable. Cash flow from operations, 6.53. It's a great cash conversion. And on a market cap of 6.8 bill, that's not too shabby. You'd be paying roughly, if you paid the market cap 1 times last 12 months free cash. And given the fact, don't forget that they've got negative debt, you're actually paying less than the cash flows. You'd be paying about 4 billion for 5.98 billion worth of free cash as of last year. March quarter results, average coal price there in Aussie dollars. Again, it's very difficult to use that because it's a blend into more different coal markets. But 0.6 billion increase in cash holding. I mean, this is crazy. 2.8 billion in cash as of the end of the first quarter. Okay, so that works out to be roughly $2.12 per share in cash. Okay, that you buy. Crazy. 11.2 million tons, okay, of coal production, 7.7 megatons saleable coal production, and yeah, saleable coal production, coal sales. I mean, they're selling a lot of coal. They had a production miss due to some weather issues. That's one risk that you're going to have with the company is production risk. However, on the other side, if there's bad weather with their mines, chances are that other producers are also going to have impacted production. And so you would see the supply come offline in general, I would expect, and therefore prices would have to rise across the board. So they may lose a little bit from a loss of production, but may gain a little bit more or have a little bit more efficient margins with higher prices. Speaking of coal prices, here we're looking back over 5 years, and we've had this awesome run up recently that has now cliffed over. Whether that's on a similar deal to oil, irrational fears of recession, you be the judge. I just look at this and say, okay, well, what's a feasible coal price? Yeah, anywhere around $100. If this company is a good investment at $100 long term, would I be interested? And the answer is yes. Big story with this company and some of the other companies that I really like at the moment, particularly in the oil space, is they pay out in dividends. And we've seen the likes of its peers, so New Hope and Whitehaven, using a lot of buybacks. That's not a bad thing. It's not the end of the world, but it appears that it's just kind of doing that to prop up its share price. And this is something I learned or that was made aware to me by Ron Shamgar. And if you look at my interview with Ron, one thing he says is, look, why don't you just pay us out the dividends, and then we, the investors, will decide what to do with that cash flow. And if we want to buy back more of your shares, then we can do that. We don't need you to do that. Yes, it's less tax efficient, but I guess it gives some more optionality. So $2.83 worth of dividend income has been paid out over the last 4 years. Now that's half the market cap. Okay, so if I say to you today, hey, here's an investment, and in 4 years, you're going to have half your investment back purely in cash returns. And by the way, you're still going to have equity. And by the way, that equity is going to continue to produce more cash flow. And oh, by the way, that equity's got a stack of cash in it. It sounds like a pretty good recipe to me. So here we come to the back of the envelope valuation. We'll use earnings per share and EBIT to keep things really super simple. Currently, the share price is 5.16 as of recording. 2.12 per share is held in cash. Okay, so you're paying $3.04 really for the enterprise value of the company, the ongoing enterprise or operations. EPS and EBIT per share is expected to come in at 2024 at 2.65 and 2.98 respectively. Which multiple do you put on it? Do you put on do you put a 1 on it? Do you put a 4 on it? I don't think you put any more than a 4. 1 is just absurd, and you'd make your money back by dividends anyway. So I think 3.6 is a median over the last 5 years, from what I can gather. 4 times EV to EBIT is a 24%. 25% EBIT yield is phenomenal. So using these as my particular estimates, that's what I've chosen to go with. We get an average price or an average expected value of 10.73, so $10.73, which from today's price alone would be a 208% upside, not including any dividends that may be dished out along the way. So interesting to say the least. Here's a little bit more in-depth assumption that I've fleshed out Using the rest of 2023 through to 2027, I'm not going to use a big long stream of like 10 years cash flows because it's just harder to work with cyclicals, and we don't know what regulation is or isn't going to do with this industry. Tax rate I've bumped up a little bit from where it's at, so I've allowed for extra taxes up to 30%. I've used a 10% discount rate, whereas the weighted average cost of capital is actually below 8, and the Aussie bond spread between the Aussie and the US bond is only about 4 basis points. So it's really negligible. I've gone with a 10% discount rate. Okay, you can change that if you don't like it. All right, simple as that. EBITDA multiple, again, using a 3. It's currently trading, I think, like what we said, 1 times next year's EBITDA, which is pretty crazy. Price, shares outstanding, debt, cash, capex, and what else do I need to tell you here? I've decreased the expected EBIT and I've smoothed it out using like a 5-year expected average. Okay, so that's one way that you can do it. It's one way that Aswath Damodaran, founder of valuation, or the professional valuation, recommends due to cyclicals. It's obviously not going to be the same every year. It's going to be difficult to predict those swings, but we can have a look at the past, have a look at the future, and we can kind of smooth it out and see if it makes sense. What we really want, rather than get caught up in these numbers, is to see, is there a massive upside? Is there a massive margin of safety? And I believe that there is, for many reasons. DNA, same thing has been done with DNA and CapEx. Okay, so if we look at unlevered cash flow expected, that's working out at the moment to be around about $1.40 per share. Okay, so you're paying $5.16 minus, you're actually paying, here it is here, $3.40 is what you're truly paying, even though the share price says 5.16. Why? Because you're getting that cash on the balance sheet. Okay, so if you're paying $3.40 for the ongoing operations of the company, then you're getting $1.40 expected back in free cash flow. It's, you're making your money back in 2 and a bit years. And given the speed at which it'll go back to your pocket as dividends, I personally really like it. And that's what I think gives it a margin of safety. The shareholder return program and the industry, the low valuation multiples, super low prices, and the cash on the balance sheet, combined with the fact that if the coal price were to drop, this company would still do just fine. Coal's not going away, and I think that, look, if we look at the coal price here, as I've listed as one of the potential risks, if we take the 2019, so pre-COVID and all that stuff, price at about $1.19, this company will still make roughly $1.2 billion in free cash flow. And if I'm paying $4 billion enterprise value for that cash flow today, it's really not the end of the world if it drops down to this level. Okay, I'll still have roughly a 25% free cash flow yield. Okay. Production miss is more important because if you have a shutdown because of weather and those things you can't control, that'll be a bad quarter or half year. But that's just the price that you pay, I suppose. The take under it'll be bad press. I don't think it's a realistic threat because national security and regulatory bodies will mean that people will block the deal going through. Simple as that. So for me personally, just my own personal investment programs, I'm accumulating. It's cheap on every metric. You're earning back your investment in 2 to 3 years, whilst we're at the very time when we're on the dawn of a commodity bull market. Their shareholder returns are very important. So 50% free cash flow as a dividend, I like that. I really, really like that. I'm happy with buybacks, but I prefer this type of strategy. Okay, having said that, guys, if you're interested in more of my work, what I do, please do like and subscribe to the channel. Leave a question, a comment. I'm on Twitter, and if you're interested in following the portfolio that's publicly available, you can either copy the portfolio with your own funds, or you can just follow and keep abreast of everything that's going on with eToro. The link will be in the description, of course. Take care, and I look forward to catching up with you in another video shortly. Bye, guys.